Matt, are we seeing catharsis today?
Well, I don't know if it's catharsis, but I do think it makes sense in the wake of an astoundingly strong CPI report on Friday. This economy is going to require higher real yields to slow down and to put some downward pressure on inflation. And that's exactly what we're seeing this morning with yields up across the board, real yields leading the move higher. And the yield curve flatter. One of our key themes
Right.
at Morgan Stanley has been the flattening of the yield curve, and we do think it will invert again, as it did this morning, and it will invert to levels that we have not seen in
Right.
decades.
Matt, you are an outstanding student of behavior with your expertise on Japan. Your Michael Wilson is maybe the strategist of the moment with a real cautious call on 2001 into this year. He looks this morning for a change in corporate behavior. Do you agree?
Well, interestingly, I just came from a trip to Japan. I was out there last week with a colleague, Jay Backow, who runs our securitized products research. And, what we saw out in Japan suggests that until you start to get some inflation, you shouldn't expect to see corporations change their behavior. And I think because we have inflation here in the US, it certainly makes sense to me that we're going to see some changing behavior out of US corporates. I mean, the dollar strengthening again this morning should ultimately result in some change at the U.S. corporate level.
Okay, well, let's talk then more about U.S. inflation and the Fed's policy response to that. Steve Englander over at Stanchart publishing this morning saying he sees 50 basis points in June, July, and September, 25 basis points in November. He says the reason why he's sticking with 50 is because of indications that activity is slowing down, so the Fed has to avoid overdoing it and having an abrupt about face. The market is also now pricing in rate cuts in the second half of 2023. Matt, is this just a story of the Fed moving aggressively now and then having to cut in rather quick fashion after the fact?
Well, I mean, that's what it looks like in market pricing. But I would just, remind your listeners and your viewers that last year, the market thought the Fed terminal rate would be 1.5% looking out into 2022, 2023. So the forward market has a guess as to what's going on, but it's typically the wrong guess. So I wouldn't spend too much time focusing on what's going on in the longer dated forwards. But to the point of going 50s, I mean, look, the Fed doesn't have much reason at this point to slow the pace of rate hikes until it at least gets policy rates to a neutral setting, which ultimately would imply a string of 50s between now and the September FOMC meeting.
How close is the Morgan Stanley view right now, Matt, to the Deutsche Bank view, a 4.125% terminal rate at some point next year?
Well, Lisa, that's not our view at the moment. Ellen Zentner, who runs our U.S. economics effort, she currently has the terminal rate in the low threes. But, let's be honest, things are changing very quickly, and the inflation data is surprising our economists to the upside as it's surprising most people to the upside. So we're certainly not alone in that sense.
Matt, John from Marina Grande Capri, he's asking of Italy this morning. I did a log study, Matt, and it's indicative of some of these stretched series, and that it's what's called log convex, which means the second derivative is increasing to a greater point of tension. How log convex is the market right now?
Well, I mean, ultimately, I think the markets are completely riding on what's going on in the central bank community, and the central bank community is moving more and more aggressively towards tighter monetary policies. Inflation is really the Achilles heel of risk markets because central banks with inflation mandates have to respond if inflation is going up and might not come down anytime soon. And that's what we're starting to see is just central banks moving more and more aggressively. And that's going to put upward pressure on real interest rates. And when real interest rates go higher, valuations have to come down.